Is it possible to earn 12% per year in the stock market? And if so, how? If not, what's a more realistic rate of return to expect to make in our investments? That last question in particular is one that many people ask all the time, and everyone has a different answer to it. The reason for that is, of course, because there are so many variables that go into answering that question that it's incredibly unlikely that anybody's going to get the same exact answer as someone else. Because their situations are different, what they're investing in is different, how much they're investing is different, and their time frames are also oftentimes different. And of course, there is always the fact that you just can't predict the future of the market. Yet we still hear that you can expect maybe 6 or 7% per year on average, at least over the long term, and sometimes we even hear 8%, sometimes we hear 10%, and of course, once in a great while, we hear 12%. Now that is an incredible claim. 12% a year. That means your money is doubling itself roughly every 6 years, assuming you follow the rule of 72s, and the man that makes that claim is Dave Ramsey, someone who many on the internet are notoriously against, at least when it comes to this particular claim. Why is that? Well, you might think to yourself, that's because 12% is totally unrealistic, maybe even borderline impossible, especially for the average person. So of course the internet would be mad at Dave for making that claim. He's misleading people. Why can't he just be honest? But is he? Is 12% actually that unrealistic? Is this claim actually just a lie? Something maybe for marketing purposes? Those are some of the questions that I hope to find an answer to today. Because today we're going to be finding out if earning 12% a year on your investments is actually possible for the average person. Hey everyone, Daniel here, and welcome to Next Level Life, a channel where you can learn all about investing, debt, retirement, and many other financial topics besides, because let's face it, the schools aren't going to teach it for us. So if any of those topics sound interesting to you, or if you want to learn how to better handle your money and have more financial freedom, be sure to hit that subscribe button and the bell next to my name to be notified every time I upload a new video. And if you want to further support the growth of this channel, you can check out some of the links I've left down in the description below. It includes a 30-day free trial of Audible and a list of some books on money that I'd recommend checking out. Or you can share this video on social media with a friend and leave a comment below letting me know what topics you'd like me to cover in the future. So in order to find out whether 12% is actually possible for the average person, we need to first look at what the average person is capable of and desires to invest in. The average person probably doesn't want to spend a whole ton of hours looking at all these different investments and looking through balance sheets and all these different sectors trying to find the absolute best possible investment. There are a lot of people who do that, of course, but I would imagine the average person isn't spending quite so much time on that. Because investing just isn't quite as big of a passion of theirs as it is for some people. But they do realize how important investing is, so they do invest, but they aren't necessarily trying to find, again, that diamond in the rough stock that nobody's heard of yet but will eventually grow exponentially. That doesn't mean that they can't chance upon that stock, they're just, again, they're not spending that much time researching for it. And as a result, they're either more likely to put their investments into whatever their financial advisor tells them is good, or to invest in index funds like Warren Buffett suggests. Since there's no way for me to know what this hypothetical person's advisor would tell them is a good mutual fund, I'm just going to assume that they follow Warren Buffett's advice and buy an index fund. In addition, I'm going to be using different dates than I usually do in these videos because I have seen a couple of people complaining that I always use the same dates, namely the dates of the last 40 years. People have pointed out that the last 15 to 20 years have been some of the worst in the history of the stock market, and in terms of just pure stock value appreciation, they have a point. Of course, that's not exactly the most important thing to look at, which I've already covered in a previous video, link in the description, but that doesn't mean that the idea isn't valid, because it certainly is. So in the interest of taking out two birds with one stone, I'm going to only use the dates from 2000 onward in this video. So let's get started. In this video, I'm going to be using 3 different index funds as examples. One of them is going to be a small cap fund, one of them is going to be a large cap fund, and one of them is going to be a biotech fund. That way we get a good mix of different sizes of companies and some more focused investments so that we can see a little bit of everything. The 3 funds I'm going to use are the IJR fund, the IBB fund, and the ONEC fund. Why only 3 funds? Take a look at how long this video already is with just 3 funds. That's why. Lastly, before we get into the actual numbers, as always, I want to say that past performance does not predict future results, and I'm not saying that anyone should go out and buy any of these 3 funds, nor am I saying that they shouldn't buy any of these funds, just using them as examples. As always, be sure to speak with a professional that can help you look at your specific situation before making any major financial decisions. So let's talk about how this is going to work. I'm going to start by taking a look at what the rate of returns would have been on each of the funds had we put $10,000 into the market right at the start and then just let it grow from there. And then I'm going to look at how much of a difference we would see in the rate of return if we were investing regularly. Instead of putting in $10,000 a month at the start and then letting it sit, we're just going to put a certain amount in every month and continue doing that throughout the entire process. Let's get into the funds. So first, I'm going to start with the ONEC fund. This is a fund that aims to track the NASDAQ Composite Index, which I've covered in previous videos, and you guys are probably already fairly familiar with it, since it, along with the Dow Jones Industrial Average and the S&P 500, is probably one of the more well-known indexes. It is considered a large cap fund, which basically means that most of the companies within it are fairly big companies, and it was created on September 25th, 2003. So I'm going to be going back pretty much as far as I can with this index and say we started investing in October of 2003, and then let the investment grow until August of 2018, which is the latest date I have as of the recording of this video. Assuming you invested $10,000 into the fund in October of 2003 and didn't invest anything more until today, except for the small amount of dividends that you would have gotten over those 15 years, the fund would have grown from $10,000 to a little over $46,000 after all of those expenses have been taken out. That's an average annual rate of return of a bit under 10.9%. Not bad since we were investing during part of the dot-com bubble and had to go through the entire housing crisis, but it isn't 12%. Let's take a look at the IJR fund next. The IJR fund is a small cap fund, which basically means that most of the companies in it are fairly small, and it seeks to track the investment results of the S&P Small Cap 600 Index. This one has been around a little bit longer than the ONEC, so it enables me to go back a little bit before the dot-com bubble burst, which is what I'm going to do. We're going to start in June of 2000, which is right about when the dot-com bubble was about to burst, and then we're going to again go all the way until today. Again, let's assume that we put $10,000 into the market in June of 2000, which was obviously not the best time to invest a huge chunk of money, and let's assume that, again, with the exception of dividends, which we will reinvest, we don't put anything else in. We just let it ride. After expenses, we would have an investment that is worth about $62,500, give or take. That's a rate of return of about 10.6%. Again, not bad, especially considering we jumped in right before a crash and didn't continue investing to help ourselves recover our net worths quicker, but it's still not 12%. So let's take a look at the last one, the IBB Biotech Fund. The IBB fund seeks to track the investment results of an index composed mainly of biotech funds, obviously, and also pharmaceutical equities that are listed on the NASDAQ. Again, unfortunately, like many index funds, it hasn't been around for a super long time. The IBB was created on February 5th, 2001. So that's as far back as I'm going to be able to go with this one. For the record, this is why I usually use the actual indexes in my videos as opposed to specific index funds, because they've just been around longer, so we have more data on them. But anyway, say we put $10,000 into the IBB fund in February of 01 and just let it grow just like the last two investments all the way to 2018. After expenses, that investment would be worth about $37,500 today, again, give or take. That's a return of about 7.83% per year on average. Not quite as good as the other two investments, and certainly not 12%. So looking at the numbers, it does seem that in terms of just pure growth on $10,000, or $1,000, or whatever it happens to be, at least over the last 15 to 20 years, doesn't seem to be that realistic. However, the average person working and continually investing isn't just putting $10,000 in at the beginning and letting it ride. They may or may not even have $10,000 to be able to put in right at the beginning. What they are doing is continually investing a certain amount every month until they decide to retire. And I would contend that the average person isn't quite as concerned about what their rate of return on $10,000 would be as they are concerned with how much their net worth is growing on average every year and how much can that net worth buy them today or a year from now or 10 years from now. So with that in mind, I decided to go back to those same funds and see if there would be any difference in the annual rate of return if we were investing every month instead of just putting $10,000 in at the beginning and letting it ride. I assumed with all three of these funds that we started with zero and invested $300 a month. Under that scenario, if we invested $300 a month in the ONEC fund over the same period of time, after expenses, we would have a net worth of right about $164,000, which means that our actual effective annual rate of return is about 13.9% per year. But wait a minute, wait a minute. Didn't that same stock over the same period of time only get us 10.9% just a couple of minutes ago? What the heck happened? Well, a couple of things happened. First, we started looking at the growth of one's net worth as opposed to just the growth of $10,000 invested as a lump sum. And secondly, we were taking advantage of compounding frequency. Before, we put in $10,000 right at the beginning and then just let it ride. Now we're adding investments every single month, $300 at a time, which means that we're actually compounding the amount in our investments every single month. So even though the stock prices are going up and down in the exact same way as before, we're recovering from some of those drops and taking better advantage of some of those highs because we're continually buying more shares. Which also means that when a dividend is given out, we're getting more and reinvesting it to continue building this investment snowball. It's really a powerful thing. And if you want to check the numbers for yourself, look up a compound interest calculator. I recommend the one on thecalculatorsite.com because it allows you to change from years to months and is just a bit more flexible overall than some of the other ones I've found, and it is the one I used for this video. But if you start with the base amount of 0 at an annual interest rate of 13.9% over the course of 178 months, which covers our time in this investment from October 2003 to August of 2018 when I'm recording this video. Put in a regular monthly deposit of $300 with a yearly compounding interval, and you'll see that the net worth at the end is $163,900, which is right about what we ended up having in our example. Just for fun, I recommend you look down at the bottom of those calculations and see that it has numbers for the base amount, the interest rate, the effective annual rate, which is the one that we as individuals would be more interested in, and the calculation period. You'll notice that the interest rate and the effective annual rate are the same in this example. But if you go back to the top of the page and change the compounding interval, which is another way of saying compounding frequency, from yearly down to monthly, you'll notice that not only is your ending net worth different and higher than before, but that effective annual rate shoots up to 14.82%. Simply because it was compounding more frequently in this particular case. That, in a nutshell, is why it's advantageous to continue investing on a consistent basis, because you're giving yourself at least a little bit of a boost in terms of rate of return just by being consistent. And if we take a look at the IJR fund and do the same thing that we did with the ONEC fund, where we're investing $300 a month, but this time it's over the course of 218 months, we see that we have an ending net worth after expenses of right around $223,900. When we put that into the compound interest calculator, again with 0 for our base amount since we're starting with nothing, 218 months for our calculation period, $300 being deposited every single month, and compounding yearly since we're trying to figure out what our annual rate of return is. And you find that in this example anyway, we achieved an effective annual rate of return of something like 12.2%. Looking at the IBB fund, the numbers are fairly similar. Again, $300 a month is what we're investing, 210 months in this example, and we would get a net worth of about $238,500 and an effective annual rate of return of right around 13.7% per year. So is it realistic to expect a 12% rate of return in the market? Well, especially if we're going just purely based on the growth of a lump sum amount, probably not, especially over these last 15 to 20 years. However, if we take advantage of some of these investing tricks, it is possible to have our net worth increasing by an average effective rate of return of 10, 11, or even nearly 12%, even in these last 15 to 20 years. So while I personally wouldn't expect a 12% return myself on my investments, I usually figure somewhere in the neighborhood of 7 to 8% per year, and anything above that I consider just to be a bonus. It is technically possible, even for the average investor. Now, the last thing that I do want to point out, because I know you guys are going to point it out in the comments if you haven't already, is that if you do account for inflation, the numbers would obviously be different. And I would recommend keeping inflation in mind simply because the amount of money you have isn't necessarily as important as what you can actually do with it. So if you do account for inflation, which is averaged about 2 or 3% per year, then you could argue it is difficult, if not impossible, for the average person investing in index funds to average 12% per year through the stock market alone. Especially if you're retired and not increasing your income through either raises or some sort of side hustle. And while that may be true, even if you took 2 to 3% off per year for inflation, we're still looking at an average annualized effective rate of return of 9, 10, or maybe even 11% per year, depending on what you're invested in, of course, even with the dot-com crash and the housing crisis factored in. Which isn't half bad if you ask me. Ultimately, the thing I want you guys to take away from this video is that, in the end, the key is to just keep investing. Because whether you're getting 6%, 8%, 10%, 12% in the market, whatever it may be, they're all better than zero. Hey everyone, quick post-production note. I recorded the audio for this video originally at the beginning of September, so I was using dates up through August of 2018, since that was the last full month that I had access to at the time. But I did want to give updated figures through October of 2018, since this video will be going up in early November. So after the quite horrible month that October was for the market and these investments in particular, the current return figures for the IBB fund is about 11.8% per year through October, after it lost roughly 16% of its value in October. For the IJR, it's about 10.5% after losing about 15% of its value through October. And for the ONEC fund, it is actually still 12% after losing only 13% of its value through October. But I just wanted to give that update because obviously October was not a good month for investments. But that'll do it for me today. Once again, if you enjoyed this video, be sure to subscribe and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.